keep the flexibility for your lifetime for the 1.0, and then the 2.0 to keep and build the legacy, financial legacy outside of your taxables. What are the benefits of the Deferred Sales Trust? We'll call this one the Deferred Sales Trust 1.0. But like I mentioned before, it's typically a promissory note that we set up where you sell in exchange for a promissory note to a third-party trust, of which our company, Capital Gains Tax Solutions, is a third-party trustee. And then that trust, that newly formed trust, sells it to the ultimate buyer, the asset to the ultimate buyer. The cash comes into the trust, and what you receive is a promissory note, somewhere between 6 and 9%. And it's paid, it's compounding, typically paid over a 10-year period of time, and paid typically, half or all of the interest, depending on your risk tolerance and your cash flow needs. We can structure that, and that becomes taxable as you receive the payments. But you're just think about like a delayed tax trust, right? Where you're delaying, kind of like an IRA, kind of like a 401k. You receive as a promissory note. You become the lender. You've lent the funds to the trust in exchange for a promissory note, because you sold your asset to the trust, and the trust ultimately sold it. And we'll walk through that here in a minute as well. But what you gain from that is the liquidity and the diversification with the funds, which we touched on previously. Also, typically no debt replacement. If your debt is not above your basis, you can be debt-free, which is nice, especially right now with debt that is adjusting, and it has adjusted over the last 12 months. We've seen some of the biggest increases in interest rates, which is also why the Deferred Sales Trust is perfect for times like this, because you can get out of debt, you can get diversified, you can get liquid on the sidelines. And again, you don't have to replace that debt via a 1031 exchange. We also talk about the ability to partner with the DST to purchase new property at any time. And that's so crucial, because back in 2008, had we had the crystal ball, we would have sold everything in 05 and 06. It kind of really happened in 07, but 08 is kind of where a lot of it happened as well. We would have sold, we would have paid off all of our debt, diversified into the Deferred Sales Trust, wait on the sidelines. We call this hindsight is 2020, but there was actually someone who actually did this and executed this business plan perfectly in what's called optimal timing. So we can do that with the Deferred Sales Trust, right? And so if you're looking at this saying, hey, Brett, can I get back into real estate? The answer is yes. And can I do it at any time? The answer is yes. And that's really the foundation of why we started Capital Gains Tax Solutions, is to give you that freedom and that optimal timing. And so that's really crucial there, okay? And again, it's typically a 10-year note, a 10-year term. They can be renewed every 10 years, and it can pass on to your kids via a living trust, and you can continue to renew it. And it can also, you can also pass it. It doesn't have to just be kids. It could be heirs that you name. And they can continue to step into your shoes and continue to go. This does not work for a stepped up basis. So this does not have a stepped up basis on this part, at least for the promissory note. There's no stepped up basis there. For the JV partnership with the new LLC, their stepped up basis there, the way that would be structured, okay? So keep that in mind. All right, so DST 2.0, let's move on to that. So DST 2.0 has everything that I just said about 1.0, but it also has that elimination of the 40% death tax, 40% death tax. So again, if you are above certain net worth levels, and these are 24 million married, about 12 million single now, adjusted for inflation a little bit more, but in 2026, it's set to cut in half. So it's going to be about 12 to 14 million married, about 6 to 7 single. You're looking at a 40% death tax, which again, the 1031 does not solve for, but this DST 2.0 does, without giving it away to charity, without having to buy any life insurance, and without having to do any gifting. Upon sale of your asset, we can move it outside of your taxable estate. Not only is that amount outside of your taxable estate, but anything above and beyond that grows outside of your taxable estate. Now, this is a bit less flexible when it comes to the payments, okay? And we can go more on that on a one-on-one consultation, but some people say, why not use the DST 2.0 all the time? Well, it's really reserved for less flexible payments and really getting funds outside of your taxable estate. They are the same cost to set up, by the way, but they are different parts of the tax code, and they're really reserved for larger deals. A lot of our high net worth clients, when they're looking at this, they'll do two. They'll do one of each. And so that's something to keep in mind as well. You can always do a little bit of both. Keep the flexibility for your lifetime for the 1.0, and then the 2.0 to keep and build the legacy, financial legacy outside of your taxable estate.